So I promise that I'll share with you this portfolio of ours, which went for a $759,000 jump in just a matter of 4 months' time. And when that happened, we were actually just sleeping like a baby. Now, I have been thinking of making this video for some time, and I have been looking for examples everywhere to explain a certain concept. However, based on the last 4 months market volatility, I felt that the best way to explain these concepts would be to take our own portfolio. Now, I would like to mention here that we are a private firm, and in our family office, we manage a few portfolios, but we usually don't disclose the numbers of these portfolios outside. We are not required to. However, this time I would like to make an exception because I felt that uh, the best way to explain this concept would be to share the actual numbers of our own portfolio. Now, the most important point to note here is the movement of the market value of the portfolio in the short term, which is just a 4 month period, is absolutely the wrong thing to look at. It's actually meaningless to an extent. Now, let me introduce this concept which I learned from Mr. Buffett. And in my investing journey, that has been the biggest aha moment. Earlier, I used to watch the share price movements very, very frequently. And I used to keep focusing on the market value of a portfolio. So when the market value would go up, I would feel very happy, and the market value would go down, I would feel very stressed. But I eventually learned that that is completely the wrong way of looking at investments. I eventually learned to look at investments like a business owner. And the most important part is to separate the income from the market value of the capital. Now, I learned to watch the income that the businesses are generating on an ongoing basis and understood that the market value of the capital in the long run would be a reflection of the growing income. But in the short run, they actually have very, very little correlation. And that is what misleads most inexperienced investors. Now, just like any business, the real value of a portfolio or the intrinsic value is derived from the income that the portfolio generates. And the only reason for that is a portfolio is also a collection of business holdings. So, in the long run, the market value of the portfolio is bound to be a reflection of the income that the portfolio is generating. So in the picture, which shows that the portfolio jumped by $759,000 in 4 months, it is actually misleading and it means very little. It does not tell you the income that the portfolio of businesses generate. It just tells us about a short-term market movement. Now, in the next 4 months, it can very well be a downward movement. So frankly, this jump is meaningless. Now, let me use the example of Berkshire's Q1 earnings, which Buffett discussed during the recent shareholders meeting. Now, he repeatedly urged his shareholders to focus on the operating earnings of Berkshire. And as you can see, the operating earnings have been fairly steady. Now, this is basically made up of the earnings that they generate from their holding businesses, and they also include the dividends which they receive from their investee companies and probably some interest that they receive from their large cash holdings. And this figure is fairly steady. However, if you look at the net earnings, you see it has been hugely volatile. Last year, first quarter, it was a negative $1.14 billion, and this year it has been a positive $21.6 billion. And the culprit has been the investment gains, the unrealized gains from their portfolio holdings. Now, this is completely dependent on the market volatility, and this means very little in the short term. Both Buffett and Munger have repeatedly reminded their shareholders and their analysts about this fact. Now, let me give you the example of another very favorite business of mine, which is Fastenal. For disclosure's sake, I don't own any shares in this business, but I have been watching them for some time. Now, if you look around your house, you'll see a lot of boring stuff. Fasteners, hinges, cleaning material. This company sells all those boring stuff, the kind of stuff that you find in a hardware store. But it's a beautifully managed business. They return very high return on assets, return on equity, and return on invested capital, and they have done really well for their owners. Now, as you can see, Fastenal has been steadily growing their earnings and their dividends over decades. Now, especially in the last 5 years, you can see how steady their earnings and dividends growth have been. Now, the operating characteristic of a business, that does not change whether the business is listed on a stock exchange or is privately owned. If a business like Fastenal would be a private business without any stock codes, any owner would be very pleased with the operating performance. However, just because it is a listed business, some of the shareholders who are more focused on the share price, the day-to-day movement of the share price, they will be subjected to a lot of stress due to the market volatility of the share price. If you look at this picture, see what happened between 2012 and 2017. It's crazy volatility as compared to the steady growth in earnings and dividends that the company delivered. So it's much easier for the owners who are focused on this steady operating results to enjoy the kind of upside that Fastenal delivered over the last few decades. Over the last 25 years, it has been a 100-bagger. Now, imagine if you're a shareholder who is just focused on the stock price, what chances do you have to stick to the business and enjoy this kind of an upside? Now, don't forget to watch the second part of this two-part series where I actually discussed our portfolio allocations. And if you have enjoyed this video, please don't forget to like, share, and comment below, and do subscribe to our channel. And remember to visit our blog, moneywisesmart.com. Thanks.